The stock market has only done this 3 times in the last century. Each time, it marked a turning point. Fortunes were made, and entire empires collapsed. And guess what? It's happening again right now. In today's video, we're diving into one of the rarest patterns in financial history, a sequence that's appeared only 3 times in over 100 years, and every single time, it changed the rules of the game. We'll uncover what this mysterious event actually is, why it's sending shockwaves through Wall Street, and what history tells us might come next. Because if you understand what's unfolding right now, you'll see opportunities most people won't even recognize until it's too late. Let's rewind. The first time this phenomenon appeared was in 1929, the Roaring Twenties. Stock prices were soaring, people were quitting their jobs to trade full-time, and optimism was everywhere. The Dow Jones had climbed more than 400% in just 8 years, but beneath the surface, the signs were there. Valuations detached from reality, debt piling up, and investors convinced this time is different. Then one morning in October, the music stopped. Stocks began to fall, and didn't stop falling for 3 straight years. By the end of 1932, markets had lost almost 90% of their value. The Great Depression had begun. That was the first time the market had shown this signal. A unique combination of overvaluation, tightening liquidity, and investor euphoria, followed by sudden collapse. The second time, fast forward 70 years later, the year 2000. The internet was new, tech companies were exploding in valuation, and .com was the magic word that could double a stock overnight. Everyone thought we were entering a new age of limitless wealth. Even Warren Buffett was called out of touch. But then, the same pattern reappeared. Excessive speculation, extreme optimism, and rapidly tightening monetary policy. Within months, the Nasdaq crashed 78%, wiping out trillions. And the third time? You probably already remember it. 2008. This time, the mania wasn't in tech stocks. It was in housing. Banks created mountains of debt, repackaged it as gold, and sold it to the world. And again, the same trio appeared. Overvaluation, euphoria, tightening liquidity. We all know how that ended. With Lehman Brothers gone, millions losing their homes, and governments printing billions to save the system. 3 times in 100 years, and now signs suggest it's happening again. Let's look at the present. In the last few years, we've witnessed the fastest monetary expansion in modern history. Between 2020 and 2022, the U.S. Federal Reserve printed over $4 trillion, nearly 1/4 of all U.S. dollars in existence. That money flooded into the system. Stocks, crypto, real estate, everything exploded. Then came inflation. Prices rose, the cost of living surged, and central banks started pulling money out of the system, raising interest rates at the fastest pace since the 1980s. This is where the pattern begins again. Extreme valuations. Price-to-earnings ratios of U.S. stocks are still near record highs. Tightening liquidity. The Fed is no longer printing, it's destroying money through quantitative tightening. Euphoria. Retail investors back in meme stocks, speculative assets surging despite weak fundamentals. Every previous cycle started with those 3 ingredients, and every time, the ending was the same. But this time, there's something even more dangerous brewing. Unlike 1929, 2000, or 2008, today's financial system is far more interconnected and far more fragile. Households, corporations, and even governments are sitting on record levels of debt. In the U.S. alone, total public debt has surpassed $34 trillion. That means every 1% rise in interest rates adds hundreds of billions in extra payments. Meanwhile, global trade is fragmenting, inflation remains stubborn, and major economies are no longer synchronized. Some are tightening, others are still printing. In short, the global financial system is pulling in opposite directions. The question now isn't if something breaks, it's where it breaks first. To understand what could come next, we have to look deeper, not just at the stock market, but at liquidity, sentiment, and psychology. 1. Liquidity, the hidden engine. Most investors think stock prices move because of earnings or growth. In reality, markets move on liquidity. the amount of money sloshing around the system. When liquidity rises, money flows into risk assets, stocks, crypto, real estate. When it dries up, even good companies fall. Today, liquidity is shrinking, and that's critical. The last three times it contracted this fast, 1929, 2000, and 2008, the results were catastrophic. 2. Sentiment, the psychology of the crowd. Every bubble shares the same psychology. At first, people are cautious, then they get confident, then euphoric, and finally they become delusional. Right now, sentiment indicators show record optimism, despite slowing growth, falling earnings, and higher rates. That disconnect between reality and belief is exactly what we saw before every previous collapse. 3. The trigger, what lights the fuse. In 1929, it was margin debt. In 2000, overvalued tech, POS. In 2008, mortgage derivatives. This time, it could be something different. Maybe the explosion of AI hype, maybe corporate debt, or even a geopolitical shock. But the mechanism will be the same. Confidence cracks, liquidity vanishes, panic selling, contagion. So, what exactly is this thing the market has done only 3 times in the last 100 years? It's not just a crash pattern, it's something called a triple liquidity trap. Here's how it works. Liquidity inversion. When central banks raise rates while the yield curve inverts, short-term bonds pay more than long-term. Asset inflation divergence. When markets rise even as the money supply contracts, investor complacency peak. When volatility hits multi-year lows despite clear macro risks. That combination, all three occurring simultaneously, has happened only 3 times in the last century. 1929, before the Great Depression, 2000, before the dot-com bust, 2008, before the global financial crisis, and in 2024 to 2025, we're witnessing it again. What makes it even more concerning is that corporate profits are stagnating while stock indices hit new highs. That's historically unsustainable. It's like stretching a rubber band. The longer it's pulled, the harder it snaps. Now, does this mean the stock market is about to crash tomorrow? Not necessarily. Markets can stay irrational longer than most investors can stay solvent, but history doesn't repeat itself. It rhymes, and every time this rare pattern appeared, it marked a major turning point. The key lesson? Don't focus on the noise. Focus on liquidity, psychology, and valuation. Those three tell the truth long before the headlines do. So whether the next big move is a crash or a massive rotation, the message from history is clear. Something big always follows this signal. If you want to understand exactly what could trigger the next crash, watch this next video right here. It reveals the single chart every investor should be watching right now.